Hi, this is Mike Larson from Money and Markets TV. We've seen the bubble cycle play out time and again in recent years in asset class after asset class. Dot bombs, housing, commercial real estate, oil and commodities. And I think the blame lies squarely with the Federal Reserve. By slashing interest rates and flooding the asset markets with easy money, the Fed has provided the raw fuel for multiple bubbles. That failed policy started in the Greenspan era and is clearly continuing with Helicopter Ben at the helm. Now, it's all too clear that this boom and bust cycle is happening again. And ironically, it's tech and dot-com stocks that are rallying like crazy, just like in the late 1990s. Clearly, people haven't learned their lesson. Let's take a stock like Apple. Many on Wall Street and Main Street think the company can do no wrong. But its surge has gotten so out of control that it reminds me of the love affair with names like Microsoft, Intel, Cisco Systems, and Qualcomm 15 years ago. One analyst just slapped a $1,000 target on the stock, and another upped the ante to $1,001. And some on Wall Street are now forecasting that Apple will be the first trillion-dollar company in U.S. history. Now, to reach that number, Apple would have to rise another $350 a share on top of a gain of more than $250 just since December. If that happens, it would be an 8-fold increase in the company's market capitalization since 2008. I have nothing against Apple's products. I use some of them myself. But I can't help but recall some boneheaded analyst putting a $1,000 price target on Qualcomm in 2000, right before the NASDAQ lost more than 3/4 of its value. Bottom line, Apple and a handful of other hot tech stocks like Priceline.com are now as overowned, overloved, and overbought as housing in 2005, silver in 2011, and yes, dot bombs in 2000. Even the slightest disappointment in sales, strategy, or execution could cause massive dislocations like we've seen in the past. The comparisons to 2000 are even more striking when you consider that once again, Wall Street is pumping up companies with no revenue and no business model. And in some cases, it's even the same company. Take the internet software firm Broadvision, for example. In the bubble of the 1990s, it surged to a split-adjusted price of more than $23,000 a share. When the bubble burst, it crashed all the way to $8. But after the European Central Bank cranked up the printing presses late last year, Broadvision jumped 7-fold to more than $56 a share. Or how about the most recent deal in the tech sector? Facebook buying Instagram for $1 billion. If you haven't heard of Instagram, you're not alone. It's a 2-year-old company that has a popular smartphone application that lets you take and share stylized photographs. It has only 13 employees, and get this, no revenue, none. Unfortunately, we know how this movie ends, and there are signs that this bubble may already be nearing its end. Some of the most recent IPOs in the sector, including Groupon, are getting shellacked. Broadvision, which I mentioned earlier, has lost more than half of its value since early March. And the broad stock market is wavering again, suggesting that one-way trade higher since December is coming to a close. If you haven't already taken some profits off the table, as I've been recommending, do it now. And if you own momentum darlings like Apple or Priceline, sell them. Mark my words, we're in the late stages of this bubble, and if you're not scared, you should be. I'm Mike Larson for Money and Markets TV. Thanks for watching.